Hi there, everybody. It's Ifti from Extreme Returns. I'm part of the popular investor program on the wonderful site of Etoro. They really have revolutionized the way people invest and the way people can make money. If you haven't, go over to the Etoro site and have a look. These are my stats. I joined recently. I've actually been on the Etoro platform longer than this, but not under the name of Extreme Returns, which is a fairly new account. So I'm a chartered management accountant by background. I qualified in 1995. I've worked for big blue chip companies like Unilever and Mars, set up my own companies as well. And I joined eToro because I think it's the future. Now, one thing I struggled with is to find out who the best investors are on eToro, the best fund managers, and who people should be copying. So I thought, there are other analyses out there. There's some excellent ones out there. Felix Falix, for example. There's Social Vlog as well. But none of them are done from an accounting perspective, from a financial perspective. So I thought I'd take the most copied users and have a look at them. So I've done quite a few, and I thought I would do this chap here. His name is, well, he goes under ReturnInvest. His name is Matej Kranch. I'm really sorry if I pronounce your name wrong. It's obviously from Slovenia. His stats are very good. So 93% return this year to date. We're pretty much at the end of December now. Just over 6,000 copiers, over 5 million assets under management, respectable drawdowns. And if we look in a little bit more detail, I think he's only been on just under 2 years, 33% last year. And these are the companies which he's got in his portfolio. So you can see he's got Dropbox, he's got Facebook, Tesla by the biggest holdings. Total, he's got 30. And what we're going to do, I thought what we'd do is just analyze some of the top positions. And what we're looking at is quality, value, and momentum. So let's head off to Stockopedia. Stockopedia is a wonderful resource. It really is fantastic, and it helps anybody to understand the financials of a company. So his biggest holding is Dropbox Dbx. If we put Dbx into the search bar, you'll get Dropbox. And this is what we see. Now, it may be obscured because of the screen, but quality you can see, I don't know if you can see it, but it's 94 out of 100. Value is 24, and momentum is 81 out of 100. So what we're going to do is, first of all, find out a little bit more about the company, what they do, and who they are, where they're based. So here we go. Dropbox is an online company that provides online file storage and sharing services. I'm sure you've all heard of it. The company provides a Dropbox collaboration platform which enables users to create, access, organize, share, collaborate, and secure the content. Wow, that's a mouthful. They are based in San Francisco, so not too far from San Jose, which is Silicon Valley. Now, accountants look at a lot of different measures. Every company has to give a lot of information about its in its annual accounts and its quarterly updates. If they're on the US stock exchange, it's quarterly. So let's look at the quality metrics. So we've got return on capital employed. I've explained this a number of times before. The higher it is, the better how well a company is investing money. How well it's investing shareholders' funds is return on equity. Operating margin is how much money it's making as a percentage from income minus operating costs. It's not that great, although it's in green here. We've seen much higher for other companies. So let's have a closer look. Revenue was 604 million, which isn't a great deal of money, especially by American standards for a global US tech company. went up to 845 million, 1.1 billion. This is all in dollars, 1.4 billion, 1.6, 1.7 billion in 2019. TTM just means 12 months trailing basis. So the last 12 months of earnings updates gives it 1.8. They estimate it to be very close for the full year at 1.9, next year 2.1. Compound annual growth rate is just under 29%, which is very good. So it's growing fast. I like that. However, it's been making a lot of losses. If you look at $326 million in 2015, went down to 210, went down even more in 112, jumped up considerably to 485. I'd like to know why. What did they do? Maybe invest or acquire another company or invest in itself somehow. Drop down significantly the next year. And what they're saying now is that full year 2020 estimates is going to be 370 million, which is very good. That operating margin that we saw there of 3.39 will go up considerably. What is it? 370 divided by 1908 is 17-18% roughly off the top of my head. That'll go up significantly. Good. The other measures I like to see, return on capital employed will go up as well because they're making more money next year. I like to see free cash flow per share. Now, this is a really good measure. I think, personally, it's probably the single most important financial ratio. If you were to look at just one ratio, I'd say look at free cash flow. And the reason for that is, firstly, it's really difficult to manipulate. Secondly, you're not playing any accounting tricks. It's not about spreading out the cost of an asset, like depreciating an asset over time. It's pure cash. And free cash flow means how much money does a company have left over after it's paid for everything. And when you divide it by the number of shares, you get a very good idea. So interestingly, if we look up for 2016, it's making a loss of 210 million. You can see that there, but it's cash flow positive. And I think that's really important. So although the accounts show it's just made its first profit this year, 2020, it's been cash flow positive since 2016. So in my books, it's been profitable on a cash basis for 4 years. And next year, look at that, from 2016 to 2017, it went up even more. And then 2018, even more, dipped in 2019, but it's going up again in the last 12 months basis. That's really good. I like this company based upon that. From what I'm seeing, it's very good. The other kind of measures I like to look at for quality-wise is something called the F-score. Now, this is a very famous academic called Joseph Piotrowski. So he asked a number of really simple but powerful questions. And it's called the F-score because of the financial health of a company. So I've done this many times before, but I'll take you through this once. I'm not going to do this level of detail on every stock in his portfolio, in ReturnInvest portfolio, but I wanted to do one in detail so you can see how I'm analyzing companies. So is it making a profit? Yes. Is it generating cash? Yes. Is it making more cash than it's reporting as a profit? Yes. Now, that's important because profit is an accounting term, but cash is really easy to see. How much cash have you generated? Simple. Is it more profitable than it was last year? Yes. Is the company's long-term debts reducing or stable? No. So we're going to have a look at that in a minute. Is it increasing its ability to pay short-term debts? Yes, because it's generating more cash. We've seen that. Is a company trading without having to raise funds from shareholders? Yes. Doesn't need outside help. Is pricing power improving and or cost reducing? Yes. Is it more productive than last year? Yes. So what we see is a very good, healthy company. Let's just go one moment to the cash flow statement. Now, I just wanted to see one thing here, which came up on the F score, and that's long-term debt. So we see might be in this bit here. Here we go. So long-term debt, 181, 130, 71, 89. It's jumped from just under 90 to 130. I don't think that's massive compared to the fact it's making a lot more money and it's less than 2015 levels. Okay, I wouldn't worry about that too much. I think, therefore, it's a very healthy company from that perspective. From a quality perspective, it's got 94. Value, 24. So the value indicators are PE ratio. Again, I've explained this a number of times before. The higher it is, the more expensive the stock. We've seen a lot of US companies a lot higher than 24, 25. I think Amazon was on 71. It is, however, higher than the S&P 500. So if we go to Stockopedia homepage, we'll see here, S&P 500, 20, pretty much 21. And if you look at all of the companies on the S&P 500 and look at just the PE ratio, I can find it. Let me see if I can find it for you. Here we go. So if we look at PE ratio, some of them are ridiculously expensive. So you see on the S&P 500, a number of companies in the hundreds. Look at that, Tesla 173, Under Armour 116. So when you go to Dropbox and you see, what was it, 25? 25, that's not too bad. It's not paying a dividend. I don't like that, but then I expect it to pay a dividend in the coming years. Then it'll be a really good stock. Momentum-wise, it's 81, which means it's really good. It's outperforming the market by 31% over last year, outperforming the market by 16.5% in the last 3 months. Dropped off 6 months ago, and over the year, it's outperformed by 21%. Now, let's see what's going on. This is if you look at the share price, right? First of all, let's look at pre-pandemic. So you're looking at around $18 per share. It's 25 nearly now. And it jumped to 43 before the pandemic. Dropped down to 15, went up, went down, went up. This is a yo-yo stock, although it's been going up steadily. Look at that. Dropped, jumped, dropped, jumped. I don't like these kind of stocks that are so volatile. Look at that, 23, it went down to 19, lost 20% of value in the space of a few days. If you want to buy this stock, buy it on the dip, please. Don't buy it when it's at the top of its range. Let's go back in time and see what it's like. No, it's a very volatile stock that I don't like. Okay, so that's Dropbox. So next in Matej's portfolio is Facebook. Now, I'm not going to do this level of detail for all of these shares. I have done Facebook in some detail, and I'll post the link below. If I forget, please remind me. So Facebook, quality-wise, is 99, value is 31, and momentum is 78. I don't know if you can see that. That's here in the top right-hand corner. And excellent company, PE ratio 25, doesn't give a dividend. Now, Facebook is sitting on a massive cash pile. There you go, look, 55.6 billion. and its free cash flow per share went up from 2.06, 2.7, nearly 4, nearly 6, dipped to 5, went up to 7.38. It's a cash generating machine, it is really good. Next is Tesla, and I've done this, done a separate video for Tesla as well, so I'm not going to go into too much detail. Let me just point out one or two quick things about Tesla. The quality is 65, value is 2, so it's really overvalued at current levels. Momentum is 92, and you often see that where momentum is high, value is low. That doesn't mean the share price is going to go down just because it's overvalued. It means that the expectations for this company are very great. It's 463 billion market cap. Interestingly, number of things about this, but let's just point out one or two. Look, major shareholders, the biggest shareholder is, as we know, Elon Musk. He owns just under 18% of it. And this company has just been going on a fantastic run. If you look pre-pandemic, it was around 180. Look at that. It's gone up to 655. In fact, the 1 year you can see here, momentum relative strength is 581% superior to the market. It's brilliant. Anybody who bought this company a year ago will be laughing all the way to the bank. Alibaba. So again, this is another company I've looked at in quite some detail, so I'm not going to do a full analysis of it. I will post the link below. 85 quality, value 24, momentum 55. Now, Alibaba is interesting because they are undergoing great financial scrutiny from the regulators in China. Jack Ma has probably said some things which upset them, and they were about to spin off part of their company called Ant Financial, make a ton of money. That was already priced into the stock, but at the last minute, the Chinese authority said, nope, we're not going to let you do that until you tick these extra boxes. Those extra boxes meant that the value of the company couldn't be priced as it was. They had to pull the IPO. Alibaba price went down. That's what this dip here is for. Then the Chinese authorities started asking more questions about Alibaba itself. So it dipped even more. I think it fell 13, there you go, 13% in 1 day. Now, this might actually be a good time to buy the company. If you look at Matej, he's now sitting on a small loss. So I'm not going to go through all of these companies. I've gone through his top 15. So he's got Walgreen Boots Alliance, the chemist retailer, Foot Locker, Berkshire Hathaway, Warren Buffett's company, Nextra Energy, that's an interesting one, Wynn Resorts, Neo, I'm holding Neo, Microsoft, I've got Microsoft as well, PayPal. So he's got a good mix of companies. So what I've done is I've gone through the top 15 holdings, and lo and behold, in a spreadsheet, put it in. So this is Dropbox. This is the percentage he was holding when I put this spreadsheet together. I think it's roughly the same now. Quality-wise, value and momentum. So I've put these numbers in, you can see, for all of his top 15 holdings. And then you get an average of 77 in terms of quality, 33 in terms of value, and 74 in terms of momentum. So what that means is he's got a decent quality portfolio with reasonable value and good momentum. If you look at quality, the reason he's got high quality is that some of his companies are in the 90s. Look at Microsoft, 99, Alibaba, 85, Foot Locker, it's 92, that's not bad. There are others which are dragging it down slightly. So you've got Tesla, which I think will improve in time. Wall Boots, Wall Green Boots, what is it? How do you say it? Wall Green Boots Alliance. That's a mouthful, isn't it? Neo. Now that's a bit of a bet. I've got Neo as well. Quality is poor under today's metrics. I think it'll improve significantly. Value, 33. So if you look at the ones bringing down, Tesla, Neo, AMD. Momentum, reasonable. Most of them are very well priced. This one is low, and most of them are very good. Let's look at sector diversification. So he's got US tech companies, automation. He's got Berkshire Hathaway, which is, I think of them as a financial company. They've got a lot of banks, although their biggest holding is Apple, funnily enough. But Warren Buffett loves financial services. CRM, which is US tech, that's Salesforce. He's got Foot Locker. I think it's reasonable. He has got 3 or 4 different sectors. International. So I'm looking for non-US. So Alibaba is non-US, it's Chinese. Apart from that, what TPR? Tapestry. I think that's Coach. This is not one I've seen very often in anyone's holding. And I like to see that in the top investors. So it's US consumer cyclicals. Okay, so that's good, but that's still US. So of all the non-US companies, he's only got Alibaba. I'd say that's poor, actually. I'd like to see 1 or 2 more big holdings for non-US companies. And the reason for that is because the dollar's so weak. Therefore, non-US companies or those who are earning their revenues outside of the US have got an advantage. Non-US tech versus the rest. So he's got Foot Locker, which I like, Berkshire Hathaway, WBA, Nextra. I think this is good. In fact, I'd say very good, because the over-reliance upon US tech alone is not good enough. Cash holding, so I like to see between 5 and 10%. That's the norm in the fund industry management in terms of cash. And the reason for that is simply because you can take advantage of opportunities. Now, I'm not sure if you can see it, but it says 6% here in the corner. So that's very good. I like that. And number of companies, the ideal number of companies to hold in a portfolio is between 15 and 25. I've discussed this at length in other videos. I might make a separate videos all about it, backed with the research. Statistically speaking, if you go much beyond 25, then your marginal gains are diluted. Matej has got, I think I saw 30. So it's not as bad as some of the others who've got much bigger holdings. But I think that's poor. Not too poor, maybe being a bit harsh. Now, I've compared him to other top traders, and I'm not going to go through all of them now. But generally speaking, if you look at other people like Jay or Yeppy or Richard Stroud, and HYJ Brighter, Spark Liang, Mariano Pardo. I've made videos of all of these people, and Wesley as well. Then ReturnInvest, Matej, has got good quality, reasonable value, good momentum, not the highest scores of each one, but a good portfolio. And in summary, his sector diversification is reasonable. International exposure is poor, but non-US tech companies are good. Good cash holdings, reasonable stroke poor in the number of companies. I would cut it down by 1 or 2. Now, the other thing I like to see is, where is he making most of his money? What we like to see is the biggest profit coming from the biggest holding. That's not quite the case here. His biggest winner so far is Tapestry. The next one is Tesla, which is one of his biggest holdings. Bitcoin, which is a small holding, has got 58%. First Solar, small holding, big gains. So I like to see, when you see the amount invested, you want to see the biggest holding getting the biggest returns. It hasn't got that. Let's see about the losses then. So the losses are coming in from small holdings. That's okay. Zoom. CRM is one of his top 15 holdings. Bristol Myers Squibb is just outside the top 15. Barrick Gold. So it's not so bad. He hasn't got any really bad losers that have drained his profits. So my name is Ifti. Thank you very much for listening. I'd love you to subscribe, share. If you want, come over to my portfolio, copy it. I'd really appreciate that. Put in a small amount of money and grow as I grow. I'll be posting a lot more videos. This was, however, all about Matage, ReturnInvest, good portfolio. I will be completing the top 10 very soon, and I'll then make a separate video about who the very best is in terms of the scores, because this is a very straightforward financial analysis. Thank you everyone for listening. I love you all.